The markets are closed. The screens are still. For the first time in days, nothing is moving. Prices are frozen, not because the danger is gone, but because the clock has stopped. This is the most misunderstood moment in financial markets. Silence does not mean safety. It means nobody is watching. Most investors see this pause and feel relief. They believe the worst has passed. They believe the year is over. They believe the professionals have gone home. They are half right. The offices are empty. The senior risk managers are gone. The veteran traders have boarded planes. They are in Aspen. They are in St. Bart's. They are anywhere but here. What remains is a system still running, a multi-trillion-dollar machine operating without its architects, a market driven by algorithms, junior desks, and automatic flows. This is not a quiet market. This is an unattended one. Wall Street has a name for this period. They call it Ghost Week, the days between Christmas and New Year's, a time when volume disappears, liquidity thins, and prices become fragile. In normal conditions, it takes billions of dollars to move a major market. During Ghost Week, it can take a fraction of that. A few million can do what billions usually do. That is when the most dangerous money arrives. Not hedge funds, not day traders, not speculators chasing momentum, pension funds, the slowest money in the world, the most conservative capital on the planet, the money that never panics, the money that never chases price, until it does. When pension funds move, it is never loud. There are no headlines, no flashing alerts, no breaking news banners. It happens quietly, through rebalancing notices, through allocation adjustments, through committee-approved decisions written in neutral language. But behind that language is something else: fear. Pension funds are not designed to be smart. They are designed to be safe. Their mandate is not to outperform. It is to survive decades. They move slowly because they have to. They buy late. They sell late. They are the last confirmation of a trend, not the beginning of one. That is why their behavior matters now. Because pension funds are buying, not opportunistically, not strategically, but urgently. Over $50 billion is preparing to enter the market. Not next year, not over several quarters, but now, during the thinnest liquidity of the year. This is not bullish. This is defensive. Pension funds are not buying because they see opportunity. They are buying because they see risk everywhere else. Bonds no longer behave like bonds. Equities are priced for perfection. Cash loses value silently. The old playbook no longer works. For decades, pension funds relied on a simple balance: stocks for growth, bonds for safety, time to smooth volatility. That balance is broken. Interest rate cycles have changed. Correlation has changed. Volatility has changed. And pension funds know something most retail investors do not. They cannot wait. Waiting is a luxury they do not have. Their liabilities are fixed. Their promises are written. Their payouts are scheduled. Markets can be wrong longer than traders can stay solvent. But pension funds do not get margin calls. They get political calls. They get public scrutiny. They get lawsuits. When pension funds move suddenly, it is because delay has become more dangerous than action. That is what is happening now. And this is being described as allocation, as rebalancing, as year-end positioning. Those words are comforting. They sound controlled. They sound responsible. They are not accurate. This is panic with a tie on. Because real panic is not emotional. It is procedural. It happens when committees approve actions they normally avoid, when rules are bent quietly, when risk models are adjusted instead of trusted. This is what panic looks like in institutions. And it always arrives during calm periods, not during crashes, not during headlines, but during silence, because silence creates cover. No one asks questions during Ghost Week. No one challenges flows. No one steps in front of size. Liquidity providers widen spreads. Market makers reduce exposure. Depth disappears. That is when large, slow money can move prices without meaning to. And that is the trap. Pension funds believe they are entering a stable market. In reality, they are stepping onto thin ice. Every dollar that enters now carries more weight than it should. Every buy order distorts price more than models expect. And the higher prices go, the more justified the buying appears. This is how feedback loops form. Not from greed, from fear of being wrong later. No pension manager wants to explain why they missed safety. No committee wants to explain why they stayed conservative while others protected capital. This is not about returns. It is about reputation. That is why this money is dangerous, because it does not come with conviction. It comes with obligation. An obligation does not exit cleanly. History is clear on this. In late 1999, pension funds increased equity exposure to avoid underperforming benchmarks. In 2007, they chased structured products labeled as low risk. In early 2020, they rebalanced into falling markets under mechanical rules. Each time, the move made sense locally. Each time, it failed globally. The market does not break when everyone is reckless. It breaks when everyone is careful at the same time. That is the environment forming now, a market where caution pushes prices higher, where safety becomes crowded, where exits narrow quietly. Retail investors see inflows and feel comfort. They believe smart money is validating the move. They are misunderstanding the signal. Smart money leads. Pension money confirms. Confirmation is never early. It is always late. And late money does not determine direction. It determines violence. Because once it is in, it cannot leave easily. And once it must leave, it does so all at once. This is why Ghost Week matters. Low volume does not reduce risk. It concentrates it. When liquidity returns, the market must reconcile distorted prices with real demand. Sometimes that reconciliation is gentle. Often it is not. Pension funds do not cause crashes. They reveal fragility. They show where the system cannot absorb stress anymore. And right now, the system is stretched. Valuations are high. Positioning is crowded. Volatility is suppressed. These are not signs of stability. They are signs of stored energy. Energy does not disappear. It releases, slowly or suddenly. The danger is not that pension funds are buying. The danger is when they stop. Because when the largest, slowest money finishes repositioning, there is no one left to absorb shocks. No marginal buyer. No hidden support. Only algorithms reacting to price. Only stop losses triggering mechanically. Only liquidity that appears after damage is done. This is how calm markets turn violent. Not with news, not with events, but with flow exhaustion. And that exhaustion is closer than it looks. The silence you see now is not peace. It is preparation. The market is not resting. It is inhaling. And when it exhales, it will not ask who is ready. When most people hear that pension funds are buying, they imagine something simple. Stocks being purchased, indexes being accumulated, long-term confidence returning. That image is incomplete because pension money does not move in a straight line. It moves through layers, through instruments most investors never see. The $50 billion everyone is talking about is not a single trade. It is a web of reallocations, a chain reaction across markets. Only a portion goes directly into equities. Another portion flows into exchange-traded funds. Another portion is routed through derivatives designed to reduce visible exposure. What matters is not where the money starts. It is where the risk ends up. Pension funds do not buy optimism. They buy protection. They are not betting on upside. They are insulating against failure. That insulation comes at a cost. To protect portfolios, pension funds often extend duration. They increase exposure to instruments sensitive to volatility. They rely on liquidity that only exists in theory. In normal markets, this works. In thin markets, it distorts everything. Liquidity is not volume. It is the ability to transact without moving price. During Ghost Week, liquidity is an illusion. Order books look full until they are touched. Spreads look tight until size appears. Depth vanishes the moment it is needed. This is where pension flows become dangerous, because they are large enough to matter, but slow enough to be blind. When a hedge fund enters a market, it watches price. When price moves against it, it adjusts. When liquidity disappears, it pulls back. Pension funds do not do this. Their trades are scheduled, their allocations are pre-approved, their execution is delegated. They keep buying even as conditions worsen, not because they want to, because they must. This is how price disconnects from reality. As pension money enters, prices rise. As prices rise, volatility falls temporarily. As volatility falls, risk models signal stability. That stability invites more flows. This is not a rally. It is a compression. Risk is being pushed forward in time. The most misunderstood part of this process is derivatives. Pension funds publicly describe themselves as conservative. Privately, they rely heavily on instruments that behave violently under stress. Options, swaps, structured exposure tied to volatility and rates. These tools are not evil. They are efficient, until they are not. Derivatives require continuous liquidity. They require counterparties willing to adjust exposure dynamically. They require markets that function smoothly. Ghost Week markets do not. When volatility is suppressed artificially, derivatives misprice risk. They become cheaper. They become attractive. Pension funds use them to hedge, but hedging concentrates risk elsewhere. Someone must take the other side. Usually, that someone is a market maker, or an algorithm, or a dealer running thin inventories. Those entities do not absorb risk. They transfer it. When conditions change, they pull liquidity instantly. This is where the danger shifts from visible markets to invisible plumbing. The public sees price holding. They see resilience. Behind the scenes, pressure is building. Because derivatives magnify moves once thresholds are crossed, they are stable until they are not. A small price move can trigger large hedging flows. Large hedging flows can trigger forced selling. This is how volatility erupts without warning, not from news, from mechanics. Another misconception is that pension money stabilizes markets. It does not. It stabilizes narratives. Markets feel calmer because prices stop falling. But underlying fragility increases. Think of it as snow covering cracks in ice. The surface looks smooth. The structure weakens. This is especially dangerous near highs. At elevated prices, marginal buyers matter more than fundamental value. When those buyers are obligation-driven, exits become asymmetrical. There are many ways to enter, very few ways to leave. The $50 billion entering now does not create a floor. It creates a ceiling of expectations. Once that ceiling is reached, disappointment accelerates. Another critical factor is timing. These flows are not spread evenly. They are clustered. Year-end rules force action. Quarterly metrics compress decisions. Everyone moves at once because everyone is measured at once. This synchronization is deadly. Markets are resilient when participants are diverse. They break when behavior aligns. Right now, behavior is aligning around caution. That sounds safe? It is not. Because cautious money all wants the same exits. When pension funds allocate defensively, they crowd defensive trades. Those trades feel safe until everyone needs them to work simultaneously. Safety becomes leverage, and leverage fails quietly before it fails loudly. Another overlooked element is currency exposure. Global pension funds hedge currency risk dynamically. Those hedges require constant adjustment. When markets move quickly, hedges amplify moves. They force buying or selling regardless of price. This creates feedback loops across asset classes. Equities move rates. Rates move currencies. Currencies force reallocations. What begins as a pension rebalance becomes a systemic event. This is not theoretical. It has happened before. The difference now is speed. Algorithms execute faster than humans can react. Junior desks follow models without context. Oversight is absent. This is what happens when adults leave the room. Markets do not behave rationally. They behave mechanically. Mechanical systems fail at edges, and we are at the edge. The public narrative says pension funds are providing support. The internal reality is they are transferring risk forward. Someone else will hold it later. Someone else will explain it. Retail investors assume pension buying means confidence. Institutions know it means urgency. Confidence waits. Urgency acts. The flows entering now are not a vote of trust in the future. They are a hedge against regret. Regret is not a stabilizing force. It accelerates decisions. The market does not care why money enters, only how it exits. And obligation-driven money exits poorly, because it exits together. This is why price behavior during Ghost Week is misleading. Stability now increases instability later. The more orderly this looks, the more disorderly it becomes. When liquidity returns fully, the market must reprice honestly, without artificial calm, without suppressed volatility. That repricing can take many forms. None of them are gentle. Pension funds do not control outcomes. They amplify them. They are not villains. They are signals. Signals that the system is under strain. When the largest pools of conservative capital start acting urgently, something is already wrong. The danger is not visible yet, but it is positioned. And positioned risk does not stay hidden forever. Markets do not break when people are reckless. They break when people believe they are being responsible. That is the situation forming now. The money has already moved. The flows are already positioned. What remains is time, and time is the most dangerous variable in markets. Next week does not arrive with news. It arrives with structure. Liquidity returns unevenly. Participants return asynchronously. Risk does not re-enter politely. The first thing that comes back is volume. The last thing that comes back is judgment. This imbalance is where damage occurs. Pension funds believe their work is finished. Allocations are set. Exposure is adjusted. Committees are satisfied. But markets do not care about completion. They care about response. Once positioning is locked, flexibility disappears. And inflexibility is fatal in volatile environments. The most important truth about pension funds is this: they do not react, they rebalance. Reaction implies discretion. Rebalancing implies obligation. Obligation does not ask whether conditions have changed. It only asks whether thresholds have been crossed. Next week, thresholds will be tested, not because of a specific event, but because distorted markets seek equilibrium. Equilibrium is rarely gentle. The price levels being defended now are not natural. They are supported by flow timing, by suppressed volatility, by absent participants. When normal trading resumes, these supports weaken instantly. The market must decide whether prices deserve to be where they are. This decision is not philosophical. It is mechanical. Algorithms test levels. Options dealers adjust hedges. Market makers reduce exposure. Each adjustment creates movement. Movement creates feedback. Feedback creates acceleration. This is why outcomes next week are binary in feeling but not in direction. The market does not need to crash to inflict damage. It only needs to move faster than participants expect. Speed is the killer. Slow declines allow adjustment. Fast moves force liquidation. Pension funds cannot liquidate quickly. Their size prevents it. Their structure forbids it. So they absorb volatility silently until they cannot. When they reach that point, selling is not gradual. It is abrupt. This is why pension funds often sell after volatility spikes, not before. They are volatility takers, not volatility managers. Another uncomfortable truth is that pension funds confirm tops more often than bottoms. They enter when visibility feels highest. They commit when narratives feel safest. Safety at scale is illusion. When everyone feels safe, risk has already migrated elsewhere. Right now, risk has migrated into liquidity dependence. The system assumes continuous liquidity, it assumes orderly markets, it assumes rational participants. None of these assumptions hold under stress. Next week, we'll test them. There are several paths forward. None of them are comfortable. One path is a sharp upward spike. Thin positioning combined with returning liquidity can cause prices to overshoot. Short positions scramble. Momentum algorithms engage. Media narratives turn optimistic. This feels like relief. It is not. Overshoots exhaust buyers quickly. They create fragile highs unsupported by depth. They attract late participation. Late participation becomes trapped participation. Another path is a false breakdown. Prices dip just enough to trigger stops. Volatility rises briefly. Weak hands exit. Then flows stabilize. Markets rebound. This scenario creates confidence. False confidence. It convinces participants that risk has passed. It invites leverage. Leverage increases sensitivity. Sensitivity increases fragility. The most dangerous path is the quiet one. Prices drift sideways. Volatility remains muted. Nothing dramatic happens. This is how complacency returns. This is how positioning becomes extreme without awareness. This is how eventual moves become uncontrollable. Markets rarely warn loudly before major dislocations. They whisper. The whisper right now is liquidity mismatch. Too much obligation chasing too little flexibility. Another factor that will matter next week is narrative repair. After holiday pauses, institutions return eager to justify positioning. They explain moves retroactively. They smooth concerns with language. Language does not reduce risk, it delays response. Delayed response magnifies outcomes. Retail investors consume narratives linearly. Markets do not move linearly. When reality diverges from narrative, trust breaks. Trust breaks quickly. This is when selling accelerates without reason. Because reason no longer matters. Only positioning does. Pension funds are positioned defensively. That means they are crowded. Crowded trades fail not because they are wrong, but because exits do not scale. If everyone needs to reduce exposure slightly, prices must move significantly. This asymmetry is invisible until activated. Once activated, it cannot be reversed. Another overlooked risk is regulatory sensitivity. Large funds operate under scrutiny. When volatility increases, oversight intensifies. Risk committees reconvene. Mandates tighten. Flexibility decreases further. This creates a feedback loop where volatility reduces risk tolerance exactly when adaptability is needed most. Markets punish rigidity. The public often believes large institutions are calm under pressure. The truth is more complex. They are calm until process forces action. Then they move all at once. This is why the most violent market days often follow periods of apparent stability. Pressure accumulates invisibly. Release is sudden. Next week is not dangerous because of a single trigger. It is dangerous because triggers no longer matter. The system is primed. What follows could be disorderly expansion or disorderly contraction. Direction is secondary. Damage comes from velocity. Fast up moves destroy short-term discipline. Fast down moves destroy long-term confidence. Both reduce resilience. Markets survive when participants trust structure. They fail when structure reveals weakness. The current structure relies heavily on assumptions of smooth functioning. Those assumptions will be challenged. Another truth that must be faced is this. Pension funds do not rescue markets. They redistribute risk. They shift it from visible price to invisible obligation. That obligation eventually expresses itself. When it does, the public will be confused. They will ask why markets moved without news. There will be explanations. They will be insufficient. The real cause will be ignored, because the real cause is uncomfortable. It suggests that stability itself created instability, that prudence amplified risk, that caution crowded exits. This is not a failure of intelligence. It is a failure of scale. Systems that grow too large become brittle. They cannot adapt quickly. They cannot absorb shocks evenly. They fracture. Next week is not about prediction. It is about exposure. Who can adjust? Who cannot? Who reacts? Who must rebalance? Markets will identify these differences ruthlessly. The greatest risk is not loss. It is forced participation, being made to act when conditions are worst. Pension funds exist to avoid that outcome. Ironically, their size makes it unavoidable. This does not end in collapse every time. Sometimes it ends in distortion, sometimes in delayed reckoning, but it never ends cleanly. Clean endings require foresight. Foresight requires flexibility. Flexibility is in short supply. The market feels calm because energy is stored. Stored energy seeks release. Release does not negotiate. It happens when constraints break. Next week will reveal which constraints matter. Liquidity, narrative, risk tolerance. One of them will fail first. When it does, others will follow. That is how systems unravel. Quietly, then suddenly. The money has already committed. The risk has already been transferred. What remains is motion. And motion does not respect comfort.